It's the June update. It's first month of summer or half month of summer, and it's quite a month in the markets. A lot to talk about, a lot to digest. A lot of new information came in during the month, and a lot of updates to our framework and what we're thinking in terms of where the economy is going to go from here. We'll first start with the return board here for the month of June, and it was probably one of the worst months I can remember across the board.
Yeah, looking at asset class returns, and these are almost through the end of the month. We're shooting this last day of the month, so They're pretty close enough. But the month-to-date time period, red numbers all the way across the board. So another big sell-off in the equity markets started at the beginning of the month. Then we had a little rally mid-month, and now selling off again, weakness towards the end of the month. The bond market continuing to see negative returns, seeing that broadening out not just to treasuries with interest rate rising, but also to credit sectors with credit spreads widening out. And then even the commodity space. First time in quite some time we've seen negative returns in the commodity space. That was the lone green box on the board. It still is year to date. But yeah, seeing some weakness in commodity prices, as well as, more and more the reality of rising recession probability is starting to get factored into consensus.
Yeah, we're going to talk more about the commodity prices. It's good news, bad news kind of thing.
Yep.
So it'll be a part of our themes here as we go forward. But let's take a look at the U.S. equity technicals, because this was a month where we actually saw value underperform and meaningfully relative to what it had done the start of the year.
Right. So looking at the different equity styles and how they've performed year to date, starting off with the dark blue line, that's the S&P 500, right around bear market territory, down about 20% year to date on a price return basis. So just about 20% off the high. And then throughout the year, what we've seen is the green line underperforming the market. So that's the NASDAQ 100 that measures growth stocks, things like infotech, healthcare, consumer discretionary, those types of companies. And then the light purple line, been the relative outperformer. So that's the FTSE High Dividend Yield Index, measures an index of high dividend yielding stocks in the US. And as you pointed out, Will, up until early June, high dividend yielding stocks are basically flat. This was almost exclusively a sell-off in the growth areas of the market, the growth in the blend areas of the market. Because up until June, this was primarily a inflation shock that led to an interest rate shock. And so what the market was adjusting, the reason for the negative returns, was just changing the discount rate of future cash flows for companies. And growth stocks are far more sensitive to that dynamic than value stocks, because growth stocks earnings, if they exist, are expected way out into the future.
Right.
Value stocks, dividend paying stocks, are generating cash and earnings right now. So that was sort of the first leg of this sell-off. And then as we got into June, and what we've been talking about for a little while is becoming a little bit more clear and present that this inflation shock to an interest rate shock is going to lead to a liquidity shock that we're in right now, and eventually a growth shock. Now you have rising recession probability. Now you have things like energy companies pulling back, anything sensitive to the economic cycle selling off. And that's the reason for value stocks starting to see some weakness here in June. So the story, the narrative is definitely broadened out as we got into June.
Yeah. So said differently, we're still in the early innings. We're just starting to see the spread of this across the market into companies that have decent balance sheets and have the opportunity to potentially survive an interest rate shock. Now with the growth shock, and we're going to talk about growth and inflation and all the things that are happening, it's a much different picture. So our investment framework, inflation, growth, prices, and recession. So we're going to start with inflation. It's the big headline. Did we peak? Did we not peak is the big question. Under the surface, we got a lot of information to share here. So we'll start with the forecast.
Yep. And so inflation headline CPI, which includes food and energy prices, May it came in at 8.6%. Hopeful that was the peak. It's probably not going to be the peak. June actually looks like it might come in a little hotter for headline inflation, almost 8.7%.
Yeah.
So hopefully that's the peak. And then once again, what's important to us is the path. Is it high or low? Well, it's clearly high. And is it going to be rising or falling? Up for debate right now over the next few months, but still plenty of reasons to believe over the coming quarters that we are going to be falling. So once again, continue to believe, have high confidence that we are moving from a high and rising inflationary regime to a high and falling inflationary regime, which is a key turning point within our investment framework, particularly for bonds. High and rising, not good for bonds. High and falling, pretty good for bonds.
Yeah, yeah. And as we go to the nowcast chart for inflation, just explain the core and headline differences real quick for the viewers.
Yeah. So headline inflation, it includes food and energy prices. They are the most volatile component of the CPI basket. And core inflation obviously strips those items out. One way to think about it is everything that the Fed is doing to try to slow inflation, you can clearly see the impact of that on the core number, the green line. It peaked in March and it's been rolling over. The headline inflation, why we've seen that continue to move higher, is because of food and energy prices, which the Fed can try to control, but more so continues to rise because of everything going on with Russia and Ukraine and commodities being in very short supply. So what we see with the nowcast is it's published by the Cleveland Fed. And what they do is track inflationary data as it comes in throughout the month to give you an idea of what the next inflation print is going to look like. So the June print is going to come out on July 13th. Right now, headline is tracking at 8.67. And right now, core is tracking at 5.66. So, once again, what's our outlook here? June may continue to be very hot headline. And it's going to reinforce all the negative narratives in the market that we're heading into a stagflationary environment, that the Fed needs to do more, et cetera, et cetera. The reality is commodity prices, food and energy commodity prices came down in June.
Across the board, right?
Yeah, totally, completely across the board, anywhere from 5 to 20% repricing of food and energy commodities during June. That's not going to show up in the CPI in June, because everybody who sells something related to commodities doesn't immediately mark down prices, but it will flow through over the next couple months. So now that we've finally seen some weakness in commodities, gives us even more confidence that headline inflation, not in June, but perhaps July, August, September, should start to roll over right in line with core CPI.
And from the Fed's perspective, how do they react to the differences between core and headline?
They know they're trying to control core, and they know what they're doing is working. But what they're worried about is everybody else in the economy, particularly consumers, their expectations for prices are based on headline. Because headline is sort of clear and present for everybody. You go fill up your car with gas, and what do you see? Well, you just paid way more, right? So they know that they can really only affect core, but they have to get headline under control, or else expectations for prices in the future keep going up. And this is something Jerome Powell addressed at his last press conference. So they're going to continue to react hawkishly. The July Fed meeting's coming up. They're going to have this June headline CPI print at 8.67. It's going to be more of the same talk.
So potential for more rate hikes faster, potentially?
Exactly. More front loading of rate hikes. Right now, 0.75% rate hike at the July meeting is definitely on the table.
Which in turn kills demand faster, which in turn slows growth, et cetera. So let's look at a question we get from a lot of clients. I think it's important for us to talk about this because it's not usually understood well as how interest rates work and what happens when the Fed raises rates and what the market response is and where that disconnect is. And when we say it's a good time for us to buy bonds, a lot of clients are like, well, why would we buy bonds? Interest rates are going to go up.
Right.
They have already gone up.
Yeah.
And I think this next chart is a really good illustration of what the bond market and what the Fed impact on the bond market is.
Yep, exactly right. Yeah, we talk about how our investment framework suggests it's a good time to buy bonds. But then on the other side of our mouth, we say the Fed's going to be hiking interest rates aggressively. How do you weigh those two things. Yeah. So what we have here is the yield curve, the Treasury yield curve. So maturities from 3 months all the way out to 30 years. And you can see where we went. The light blue yield curve was September 1st, so before this yield shock. And now the dark blue is where we are at today. And so what you see is the Fed funds rate, so what the Fed is doing, is expected to be at 3.36% by the end of this year. It's supposed to top out in early 2023, spring 2023, at somewhere around 3.5%. And then the market expects that the Fed will cut interest rates from there. So what that means to us and what you see in the rest of the yield curve is that entire path of the federal funds rate over the next 2 years, which includes more aggressive hikes and cuts, should be fully reflected in all maturities on the yield curve 2 years and out. That is a known.
Yep.
That is consensus information. The market sets those expectations for the Fed funds rate. The market also sets the yield on interest rates 2 years and out. So what's likely to happen here in our view, now that growth has slowed and inflation should roll over, is if the Fed continues to hike rates, the only point on this curve that really is going to go up dramatically is the 3-month. And at that point, the entire yield curve will be inverted.
Right. So they'll end up looking like that.
Exactly. Flat as a pancake or even inverted.
Yeah.
And so, that's a pretty attractive environment to buy bonds as you move out to 2 years. So when you buy a bond, what do you get in terms of returns? You get your yield.
Yep.
And then you get a price return. If interest rates go up, you lose money. If interest rates go down, you make money. And that price return is based on the duration of the bond. So a simple rule of thumb where you can start to analyze, is the risk reward attractive here? Let's take the 2-year, for example. So I think 1 year out, what's my expected return? Well, I get 3% yield. And then if interest rates go up 1% on a 2-year bond, that means I lose 2%. So 3 minus 2 is 1.
You get 1. Right.
And then the opposite is true. So I start with 3, and then if interest rates go down 1%, I get 2. So my total return is 5.
Yeah.
So even if interest rates go up 1% more from here and you buy a 2-year bond, the probability is over the next 12 months, you're going to make money.
Right.
Was not the case last fall.
Yeah.
Your starting yield was 21 basis points. Okay. So you almost, if interest rates went up, you were definitely going to lose money.
Right.
So at this point, the risk reward across the curve looks pretty attractive. And then think about the risk reward on a 30-year bond.
Yeah, go through that one.
Yeah, so 30-year bond, that's pricing in more of the growth outlook, the long-term inflation outlook over the next 30 plus years. And the growth outlook here is not great. And we'll talk about that a little later. But you also get way more sensitivity to interest rates. So do the same exercise. Start with a 3.22% yield. If the 30-year yield goes down 1% from here, I make an extra 30%, roughly. So your return would be positive 33. 30% on top of your yield. And typically, in a recession, that's what you see from the 30-year bond yield. Goes down about 1%. So that's another reason why the framework is starting to say, hey, yields across the curve here, especially 2 years out and longer, risk reward's starting to look pretty good, especially now that growth and inflation should be slowing, rolling over.
And the risk to all this is inflation comes in way hotter for way longer than we expect, and Fed expectations for rate hikes continues to blow past here.
Yeah, and that would be bad in the near term. But then we'd be looking at an even more attractive risk reward once that's priced in, right?
Yeah.
So the time is coming, basically.
Yes. It's a good illustration. And, if folks want to discuss this in more detail, we're happy to go through the math here and explain how this all works. But we are definitely in favor of allocating more towards bonds in our portfolios. And another reason is liquidity. And maybe before we talk about what the forecast is, which is very dire here, let's sort of try to explain what liquidity means to the average investor.
So when you think about liquidity, you're talking about dollars being created. So M2, money supply. The easiest way to think about the implications for where we're headed is to think about where we were. So after COVID, the economy was in an awful position, but markets did not care. Why? Because money was being created. And even if the economy is completely shut down, the sharpest economic contraction since the Great Depression,
right.
If money's being created, it's going to go somewhere, and it's going to go into financial assets. And really, it doesn't matter what's going on in the economy. If money is going into stocks, stock prices are going to go
right.
up. Plain and simple. That's why I call it sort of the fundamental above all fundamentals. Mm-hmm. It's where's the next marginal buyer going to come from? And so you think about everything that was going on during COVID. Think about the things that were doing really well. Options on high-flying growth stocks going crazy. Well, first it was those high-flying growth stocks. Then it was the options on the high-flying growth stocks, call options, for example.
Yeah.
And then it went into cryptocurrency.
Right.
All these assets have one common denominator. They're very momentum-oriented, or I guess you say two common denominators, momentum-oriented. And it's always about where is the next marginal buyer. As long as more money's being created, mm-hmm. it can go into these assets. Cash flows don't matter. Fundamentals don't matter. Valuations certainly don't matter. All that matters is money is being created. Right. And that is the effect of liquidity. Now imagine we go into an environment that is the exact opposite of everything we just had during COVID. All of those assets where their valuation was totally predicated on more money coming in. Where is that next marginal buyer going to come from?
Right.
If we have the fastest slowdown in money supply growth we've ever seen.
Yeah. When you were a kid, I don't know if you're more of a millennial kid than we used to play musical chairs in school. If you remember that game, so
yeah,
you walk around and you got to grab a chair. There's more kids than chairs. It's kind of like the idea here, except now we had more chairs than kids during COVID. Now we have far less chairs than kids.
Right.
So this is the type of idea here that when people are, how do people experience liquidity slowdowns in the real world?
Yeah. How it looks if you're an individual, in financial asset prices, you've seen the type of stuff that's already started to sell off. All the COVID winners, things that you thought couldn't miss, mm-hmm. whatever, they just keep going up. You don't know why those things turn down. There are a number of companies, zombie companies, that we know aren't generating earnings. They're cash flow negative, mm-hmm. but they have huge market caps.
Right.
Why? Because there's so much money, they can just attract it, whether it's through equity capital or they can roll over debt or whatever the case may be. So those companies now can't get new capital to keep things going. Right. So they either need to somehow generate earnings and cash flows to sustain the business, or they need to cut costs to sustain the business, or they go out of business. Mm-hmm. So we're starting to see that.
Another example is no more stimulus checks. You're not getting money from the government anymore. It's more difficult or more expensive to get a loan.
Yeah.
Cost of money is higher, substantially higher than it was before. And credit standards are more difficult now. So those are other examples of how you would experience liquidity dry up.
Yep.
So
not enough money, basically.
And this is, if you throw the graph back up, we're forecasting probably, is this an all-time, on a rate of change basis, this is an all-time incredible slowdown. But like what would cause this number to head back up?
So the reason why it's coming down is because the Fed is hiking rates, they're reducing the size of their balance sheet, and there's no stimulus. So to get it to come back up, they would have to cut interest rates, increase the size of their balance sheet, and we would need more fiscal stimulus.
All things that would hurt and would drive inflation back up.
Right.
So it doesn't seem likely.
Yeah, what's most likely here is it slows to something near zero early next year, finds a bottom, and then stays there for a while, which is difficult.
Yeah.
If the Fed can't pivot. So.
All right, let's move on to GDP and growth, because this is all sort of coming home to roost. We had a negative print last quarter, pretty substantial one, and I don't remember a time where estimates have been so widely distributed amongst folks on where GDP is going to come in for Q2.
Right. Yeah, we're basically there, right? Q2 is basically over.
Yeah.
You have almost all the data points. points that you
Right.
need for Q2 GDP. And so the Atlanta Fed, who does the GDP Now forecast, which tracks all the economic data points as they come in during Q2 to try to give you a real-time estimate of what the BEA is going to say Q2 GDP was when they published their first estimate late July. And right now it's sitting at 0.3. That's marginally better than where it was on June 15th when it was 0.
Right.
And that's just because the inventory drawdown maybe looks less bad than originally predicted. But, a couple things. As you said, Q1 was negative. If Q2 is negative, that's a technical recession. 2 consecutive quarters of negative real GDP growth is a technical recession. The other thing is we're talking about this is a growth shock that is not priced into markets yet. Right? We started with an inflation shock, led to an interest rate shock. Now we're in the midst of a liquidity shock, and that's going to lead to a growth shock. So the consensus estimate for Q2 is still 3%. There are 50-some contributors to the Bloomberg consensus estimate for GDP growth, and it's 3%. That seems virtually impossible.
Right.
Because the Atlanta Fed GDP Now forecast, they also publish their standard error. How off are they? And this far out from the actual number, they're on average off by 1% or less in either direction. So to get to 3 would have to be one of the largest errors they've ever had.
Big miss, right?
And then the range of estimates, consensus estimates. So there's obviously a high and a low, and you bring it together, and there's your median. So at the upper end, it's over 5, which once again seems impossible. Setting myself up for something, I guess I say that, but it seems impossible. And at the low end, it's 0.1. Pretty wide.
Yeah, and then drive a truck through that.
Pretty significant disagreement or lack of consensus.
And what's leading to that? Those forecasts being so far off, because usually they're a little more closely distributed.
Yeah. So if you think back to Q1, why it was so negative, net exports were a huge drag. We bought a bunch of stuff. We didn't sell anything to anybody globally. That's very difficult to forecast. And then the other reason why Q1 was so bad was inventory drawdown. So when we buy more inventory, we're restocking inventory. That contributes. When we just say, hey, we're just going to sell what we have, that detracts from GDP growth.
Right.
Those are the 2 most volatile, most difficult to predict elements of GDP growth. And so that's probably why at this point in Q2, there's still a lot of uncertainty with regards to those 2 items, why you're seeing such a wide divergence.
Yeah, and from our, we're working on our GDP forecast models, trying to make them better every day. But in general terms, we're towards the lower end of that estimate as well, right?
Right.
We're seeing a lot of anecdotal data, and you're starting to see a lot of hard data that would support a much lower number than some of these estimates. Okay, so all of this leads into the probably the biggest impact in our framework in terms of market returns. And that is, do we have a recession? Do we not have a recession? Because markets behave very differently in a recession.
Right. So we're at a new high for the year. Recession probability 65% over the next 6 to 12 months. And that has gotten much worse in June from where it was at the end of May, because the market-based data points that go into this forecast have deteriorated. And we've also seen some of our longer-term indicators that go into this forecast, like percentage of the yield curve that's inverted, start to deteriorate as well. And we've said this over and over, 50% is usually the point of no return. There's only one analog where it went above 50% and a recession didn't immediately follow. That was in 1998. And that was because the market-based data points in this forecast were breaking down. But the Fed, Alan Greenspan was the Fed chair at that point, he was able to pivot. And he was able to cut rates, markets stabilized, and recession was sort of put on hold for a few years. So going back to everything we were just talking about, could the Fed pivot now? Well, no, not if inflation is running above 8%.
Right.
That would be such a dramatic loss of credibility. It seems pretty much out of the cards at this point. Maybe 12 months from now they could, if inflation comes down fast enough. But right now they are constrained by inflation.
Right. So this, I think of note here, the volatility of this has been extreme, and relative to other periods where we've seen sort of the spike and then it happens, this has been quite volatile for some time. What do we, if anything, do we read into that?
Well, what's broken down first here are the market-based inputs, and those are the most volatile because they price all day, every day. As this transitions, which I think we're in that process now, from market-based breakdown to a breakdown in the actual hard economic data, then this will become less volatile. You know, things like housing starts, they're not measured daily, right? You only get a month print, and these things, once they start going in the wrong direction, they tend to continue. So,
yeah. Okay, and then in terms of, recessions and their impact on the markets, we're already down in growth stocks over 30%, and the S&P is already in bear market territory. What does a recession do to markets from here?
So for the S&P 500, for example, you basically, if we go into recession, you could say we're only about halfway done with the drawdown. That's pretty fair to say. And recessions aren't created equal. If the Fed is not able to cut rates after this recession because inflation is still running high, you could be down more than your typical recession. And then also starting points are different, right? If you go into a recession with valuations extremely high, growth stocks trading like they were in the tech bubble, well, your typical run-of-the-mill recession means you're going to go down way more. And so growth stocks in particular this time around had a pretty high starting point. Right. So it might be surprised how much they end up falling if we do go into recession.
Yeah, so we will keep you updated on that forecast. And you can see on the next chart, these are some of our indicators. I think there's a lot of the long-term, medium-term, short-term Mike was just talking about, but we're seeing a lot of the longer-term and medium-term ones starting to tick in, which will build momentum towards keeping that number elevated probably for a while. So let's look at the next chart. So all this, you would think, would be reflected in earnings estimates. However, we're going to talk about the fact that it's not, and this could be the next. It should be the next shoe to drop here in the story. So take us through what we're looking at here and why it needs to be adjusted downward.
Yeah, these are consensus estimates. So these are consensus bottom-up estimates. So you take all the analysts that are covering each stock in the S&P 500, and you say, what is the average estimate for earnings for each of those companies? And aggregate that together at the index level and say, well, what's the estimate for S&P 500 earnings this year, the blue line, and then next year, the green line? And the number isn't as important as, the path.
Right.
So everything we've just talked about, you would think if markets are efficient as you would expect and analysts are sharpening their pencils every day, you would think these estimates would start to come down. Just by way of, wanting to err on the side of conservatism. But they really have not.
Right.
They really haven't moved much. Even since Russia invaded Ukraine, they haven't moved much at all.
Right.
So this earnings season and next quarter's earnings releases, it could be difficult. I mean, I'm sure you're going to hear a lot of stuff from companies about we have the wrong type of inventory. We have too much inventory. Yeah. The cost pressures. We can't hire people. All that type of stuff.
Yeah, they don't. The CEOs and CFOs don't get any value from coming out and saying, "Hey, it looks ugly from here. We're in trouble." They paint a rosier picture. So it's tough for these analysts and these estimates to be sort of realistic. And so these will come down. What type of magnitude do we expect here, and what path?
Well, if there is an economic recession, there almost certainly will be an earnings recession. That's pretty typical. And if you look at the magnitude of the prior earnings recession, which was pretty mundane, that's the red shaded area that coincided with the COVID-19 drawdown. I mean, that's a pretty big slowdown in earnings. I mean, you have to normalize that because it was a sudden stop recession. So, maybe normalize that at the peak to 6 or 9 months out. But how you would look at it is right now, stocks look cheap relative to earnings, future earnings. And so you'd say, oh, well, valuations look good. I want to get in. But if forward estimates for earnings come down 20%, Now stocks don't look any cheaper than they did at the beginning of the year, right? So that's the essence of a value trap. The valuations look cheap now because it's sniffing out that the fundamentals are deteriorating. Now the fundamentals need to come down. And that just hasn't happened yet.
And so we're going to start hearing these things in the Q2 conference calls, into Q3, Q4.
For sure.
And do we think there's it never turns until it turns, but like what is our highest probability guess as to when this could play itself out?
So looking at our liquidity forecast, once liquidity bottoms and you actually see the Fed maybe start to cut rates, that's usually when the framework starts to suggest, all right, bad news is in, or hey, bad news isn't in yet, but prices are so cheap, it almost doesn't matter. And if you look at our forecast for liquidity, I mean, that's sort of best case scenario is liquidity bottoms and the Fed could pivot Q1 next year. So updating our estimates every day though.
Yeah, so no, that's awesome. That's great. It's a great review. And I think there's a lot of information in our appendix. We're happy to go through any of this material with you. Thanks for joining us for the month. We'll look forward to next month. We'll probably do a mid-month update just because of the volatility. And we will be, starting in August, we will be going live with a weekly show for our clients to just talk about some of these things in more detail and how they're affecting their portfolio. So thanks for joining us.